Craig, I get a version of this call almost every week. Somebody sees a rate online or on a billboard. They come in, we run the scenario, the numbers are higher. And the first thing they think about is, hey, somebody's playing games here.
And they're almost never being played. I mean, that's the part worth unpacking today, because the rate you see advertised isn't actually a quote. It's a best case example. Your real rate gets built from a whole stack of information about you and the property, and a surprising amount it isn't even known at the start.
Yeah, so let's take the mystery out of it, because this is the number one thing buyers don't understand. Welcome back to the South Florida Mortgage Report with Billy May, your hat-dude-wearing mortgage guy, always joined by Craig Garcia, president of Capital Partners Mortgage. And, we've seen some movements in the rates recently. This is always a good topic to discuss when things like this happen, right, Craig?
Yeah. So, we can talk about this advertised number and what it's quietly assuming. Talking about these rates, it's assuming a top tier credit score, a large down payment, somebody buying a single family home they're going to live in, clean purchase with nothing unusual. And a lot of the time it's assuming that they paid points up front or some type of fee up front to buy the rate down. It's usually assuming all those things.
Yeah, so it's like the car and the commercial with every upgrade and the sticker price in the window, kind of, unfortunately.
Yeah. It's a real rate. It's for a perfect scenario. And the problem is almost nobody's standing exactly in that spot. So your rate gets built from your scenario, not the billboard scenario or the quoted rate scenario typically, or the online quote.
Yeah, so you say the rate gets built. We're going to talk about that. What exactly does that mean?
Yeah, so there's more than 20 separate data points. I mean, literally, when we price a loan, we're not pulling one number off a shelf. We're feeding a stack of factors into the pricing, and each one can move the rate up or down. So the big ones, either your credit score, your down payment, your loan to value. Oh, by the way, the credit score is not the free app version, right? But it's the real actual mortgage credit score.
Right.
Not your Credit Karma score.
Right.
And so your down payment, your loan to value, the difference between 19% down and 20% down can change the price of your loan. Your debt to income ratio can matter sometimes. How you use the property certainly matters. Primary, second home, or investment, 3 completely different prices. The property type, single family home, condo, townhouse, 2 to 4 units. What you're doing, a purchase, a rate and term refinance, or a cash out. Cash out typically costs more. So the loan amount absolutely matters. The loan term, how long you're borrowing the money for, and how long you need to lock the rate. All that stuff matters.
Yeah.
Plus other stuff.
Yeah. And that's why two people can call this same lender, same day. They can walk out with basically 2 different rate quotes.
Totally. They're not being treated differently. They're just different files. In the industry, these adjustments have a name for these. They're called loan level price adjustments. But the buyer doesn't need the jargon. They just need to know their rate is personal to their situation. It's kind of customized for everything that's going on with that situation.
Yeah. So the one thing that trips people up most, Craig, is like a buyer gets a rate on the phone, and then somewhere down the line, number moves. They feel like they got bait and switch, kind of like going to buy a car. So kind of let's walk us through what actually happens there. What's the perception? What really happens?
Well, that's the important part. I mean, some of the data points, they're not even known at the beginning. When you first call, we can give you a solid, honest estimate, but it firms up as the file moves because the real numbers get verified in processing and underwriting sometimes.
Yeah. So like what specifically?
Well, your true credit score comes from the mortgage pull, not a guess. Your real debt to income isn't usually final until you've reviewed income documents. Your real loan to value isn't final until the appraisal comes back and we know what the property's worth. And your lock period depends on how long we realistically need to close.
Yes, the rate doesn't really change. Just kind of the estimate turned into a fact, so to speak, right?
Yeah, no, that's really exactly how to say it to a client. I mean, nothing shady happened. The facts came in, and here's a flip side of that. Lender who quotes you the lowest number on a 5-minute phone call before verifying any of this isn't giving you a better rate. They're just giving you a less complete estimate.
Yeah. Which sounds better on the phone. It feels worse like at closing,
Yeah.
Yeah. So for the agent and the buyer listening, I mean, what do they actually do with this?
I mean, one, get fully pre-approved and not just pre-qualified. The more of those data points we've actually verified up front, the more your quoted rate behaves like a real number instead of a moving target.
Yeah. Yeah. And two,
When you shop lenders, compare apples to apples. Same scenario, same day, same lock period, same points. A rate doesn't mean anything without the fine print under it. If one number looks dramatically better than everyone else's, the honest question isn't how they do that. It's what's different in their assumptions.
yeah, and it's not all bad news. That's why us here, at Capital Partners, we try to really scrub down the buyer up front and set the proper expectations and try to have this conversation with people, and explain to them why these things happen beforehand. Because we don't want, like you said, we don't want somebody to feel like, hey, something's moved. But sometimes, you did bring up a good point. Sometimes if the appraisal comes in low, maybe and that now we're at 84% loan to value or whatever instead of 80, maybe certain things can change, but we want to try to prepare people as much up front. So.
Yeah, no, and sometimes you have levers that you can pull too. So, pushing your credit score into the next tier, these loan level price adjusters that we talked about, sometimes there's a big difference in price by getting from a, 649 to a 680. And sometimes people can do that and make that jump with very little or less than people would expect in terms of changes to their profile. And we have tools that we run for people where we can say, hey, listen, if you pay off this credit card or pay down this credit card to this balance or these two credit cards or what have you, then that will increase your score this much. That will actually increase or decrease your costs or your rate on your loan. And sometimes that can be pretty meaningful and it doesn't take a lot of money. So, that's part of what we do when we're doing a comprehensive, analysis of somebody up front, while they're out there looking for property.
Yeah, and that's the conversation we'd rather have, not kind of like, well, here's your rate, take it or leave it type thing. And I think that's where we come in a little differently than maybe some of these, let's say, bigger lenders, maybe some online lender profiles. We want to try to help, like you said, guide the borrower along, give them, show them the tools necessary, maybe help them get a better financing terms, better interest rate.
Yeah, that's the whole job. So, I mean, three things to walk away with today.
Yeah, I mean, basically, one is your interest rate. Don't always believe what's advertised. Like that may be the perfect scenario. Yours is built from your situation. Like you said, it could be a condo or these other things or a small loan amount or whatever. Things could change.
Yep. I mean, two, your real number firms up as your income, your credit, the appraisal get verified. A rate that changes usually just means that it's an estimate that's become a fact. So work with someone who's honest about that up front.
Yeah, and three, like you said, we have levers. There's credit, down paper, structure, buying it down. We have 2-1 rate buy downs too. There's all kinds of things. So before you accept a rate, you really got to understand maybe how you can improve it.
Yeah, no. So next time you see a rate advertised, don't take it personally when your number's different. That's a best case example. Your rate is yours, 20 plus data points. Several of them only confirmed once real people verify real documents. If you want to know what your actual number looks like, and more importantly, how to make it better, that's the conversation that we have every day. None of this should stop a deal from getting done. Stock Florida is still moving. So we're doing this every day.
Yeah, and that's why I try to overemphasize about scrubbing everything up front, getting all those documents up front. So if you're a buyer out there, be careful who you're talking to, because like you said, it may just quote you something and not even really dig really deep into it. It's just the most expensive, thing you'll ever buy. So you really got to take your time and look at the whole big picture.
For sure. And it is important to keep in mind when time has passed between talking with different lenders, because rates, just like stock prices, change every day. This week, Bill, I don't know, you want to talk about the rates this week? I mean, it's
Yeah,
been
because in the
it's not
news,
been the
it's
best.
no, it's not. It's not been the best, and everybody hears the news. Oh, rates are shooting up, et cetera, et cetera. So, and it seems like the culprit here is what's going on in the Middle East, really. But let's talk about that, Craig, briefly. We've seen rates move up, and why is that?
Well, last week we had these great favorable inflation reports, which was good news for us and for the bond market as far as mortgage rates go. But unfortunately, the situation in the Middle East has been deteriorating. Oil prices are on the rise again, and oil prices going up means inflation's going up. Inflation's going up means mortgage rates are going to go up. So I did see something that, we're basically, rates right now are probably as high as they've been in the last year,
Yeah.
which is unfortunate. But thankfully, it's not. Hopefully, it's not out of control, but it is at the upper end of the range that we've had over this past year. So
Yeah, that's true. But houses are still selling. I had a closing yesterday, another closing this morning. People are buying houses, and one rate was a little less than the others because they locked it a few weeks back. But houses are still selling, so the market's still good out there.
yeah, no, it's been the summer has been interesting. It's definitely been a little bit slower than maybe last summer was. But yeah, no, but things are still moving, and yeah, no, interesting to see what happens. Hopefully, things will get under control with the Middle East situation.
Yeah, let's hope to see those rates at least hold steady, or maybe even come back down some. That'd be great.
Yeah, no, I think if they can get some if they can get some control there, I think that portends well for mortgage rates because uh, the inflation reports that have been coming out, in spite of the fact that oil had been high for a while, they've been pretty good. So, Bill, yeah, obviously, and next week we do have a Fed meeting on Wednesday. The Fed will, give us an interest rate decision. I don't think many people are expecting a move one way or the other as far as that goes. But it's, Kevin Warsh's second time up at the chance to speak. We'll see if he does. He kind of indicated last time if you don't have much to say, then, maybe he won't say very much. So it'll be interesting to see.
Yes, it certainly will be interesting. So looking forward to that. So good stuff. Oh, and lastly, speaking about rates and so forth, I have a closing today, by the way. This buyer got interest rate near 6% on a 10-year fixed product. And it was a second mortgage. Here's somebody who called me up. One of my past clients has a lot of equity, and they didn't want to do an equity line. They wanted something fixed. And they said, no, we need to do some things, and we want to take a 10-year note, and it's near 6%. So that's a second mortgage because they didn't want to touch their 3% interest rate on their first mortgage. So we can do loans like that as well. And we closed it, I think,
Which is
2
really
weeks.
interesting. Which is really great, Bill, because I think most people have the impression that if you're getting a second mortgage, it is going to be adjustable. It's going to be a HELOC, and you're going to get a rate that's going to be in the eights or higher, and that's and people don't necessarily like that combination. But hey, if they can do a 10-year payback, getting a 6% fixed rate on a second mortgage, it's pretty attractive.
Absolutely. The closing costs were very minimal. There was no appraisal. We did an automated appraisal. I took the application, I think, less than 3 weeks ago. It closed, funded within 3 weeks. It was a very seamless transition for one of my past clients, and they're very happy. So, we have some
What a
unique
great
products
option.
out there. Yeah, absolutely. So,
Excellent. Excellent deal.
all right, sir. Well, listen, you have a great day. Good seeing you again. And remember, Craig, we will see you
At the closing table, Bill.
closing tape. All right. Have a great day.
Okay, you too. Thank you for watching and listening to the South Florida Mortgage Report, brought to you by Capital Partners Mortgage Services.